Hey everyone, welcome back to Corporate Decoder, the place where we explore the deep dark secrets hidden within company filings. And well, today we have a special treat, an SEC filing that is quite a roller coaster. A company that is still trying to find its footing, and let me tell you, there are some very interesting numbers to unpack. Before we dive in, if you are as excited about unscrambling corporate jargon as I am, make sure you hit that subscribe button and join our Discord community, linked in the description below, where we break down these documents and more. Alright, so what we have here is E.S.H Acquisition Corp filing their quarterly report for the period ending the 30th of September 2025. Now right off the bat, you can see the title is Form 10. This means it is a quarterly report that publicly traded companies in the US have to file with the Securities and Exchange Commission. It is basically a status update on how the company is doing financially over the last 3 months. Let's jump straight into the financial statements. The first big one is the balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific point in time. On one side, we have assets, what the company owns, and on the other side, liabilities, what it owes, and then equity, which is sort of the owner's stake. Now, looking at the assets for the 30th of September 2025, we see cash is $135,578, and that is a dramatic drop from the 31st of December 2024, when it was over $1.3 million. That is a huge difference. A big chunk of their readily available money has vanished. The company also reports investments held in a trust account at over $8.5 million. This trust account is pretty standard for these acquisition companies. It is where the money from their initial public offering or IPO is held until they find a business to buy. On the other side of the coin, let's look at liabilities. Total liabilities are about $2.5 million as of the 30th of September 2025. This is a pretty significant increase from about $1.6 million at the end of 2024. A big chunk of this increase is in accounts payable and accrued expenses, and something called excise taxes payable, which has more than doubled. This tells us the company has more bills coming due and more taxes to pay. Perhaps one of the most striking numbers here is the common stock subject to possible redemption. As of the 30th of September 2025, this is listed at over $8.5 million. This represents shares that were sold to the public during the IPO, but because they are part of a special type of company called a Special Purpose Acquisition Company, or SPAC, they have a feature that allows shareholders to get their money back if the company doesn't find a business to buy within a certain time frame. This huge number shows a large portion of the company's equity is essentially on loan to its shareholders with the possibility of being paid back. And then we get to the bottom line for equity as of the 30th of September 2025. E.S.H Acquisition Corp has a stockholders deficit of over $2.3 million. That means the company owes more than it owns from the shareholders' perspective. This deficit has grown considerably since the 31st of December 2024, when they had a small positive equity of about $175,000. This large negative equity is mostly driven by the increasing cost of the shares that might be redeemed. Now let's look at the statement of operations. This shows the company's performance over a period of time. For the 3 months ending the 30th of September 2025, the company reported a net loss of over $802,000. This loss is primarily from general and administrative expenses, which came in at almost $853,000. This is a massive increase from the same period last year when their general and administrative expenses were just over $156,000. They are spending a lot more money on running the business. However, there is a glimmer of hope on the other side. They reported interest earned on investments held in the trust account of almost $88,000 for this quarter. This is a positive income stream. However, it is considerably lower than the nearly $1.6 million earned in the same quarter last year. This indicates that either the trust account balance has decreased or the interest rates have fallen. Zooming out to the 9 months ending the 30th of September 2025, the company reported a net loss of over $2 million. Again, general and administrative expenses are the main driver of this loss, soaring to over $2.2 million for the 9 months, a huge jump from just over $500,000 in the prior year. The interest earned on the trust account for this 9-month period is only about $260,000, a stark contrast to the over $4.7 million earned in the first 9 months of 2024. This significant drop in interest income combined with the soaring expenses paints a picture of a company burning through its capital. This statement details how the equity section changed over time. We can see here the movement from the 31st of December 2024 to the 30th of September 2025. The retained earnings or accumulated deficit has swung from a positive $175,000 to a negative $2.3 million. Much of this is due to the net loss in operations and the accretion of the redeemable stock increasing the overall deficit. It is clear the company is moving from a position of small profitability to a significant deficit. The statement of cash flows is crucial. It shows where the company's cash is coming from and where it is going. For the 9 months ending the 30th of September 2025, the company used over $1.6 million in operating activities. This is largely due to the net loss and changes in their operating assets and liabilities. For example, they owe more in accounts payable and excise taxes. Investing activities show them investing money into the trust account and also withdrawing funds to pay taxes. Financing activities show some proceeds from related parties, suggesting they are getting money from somewhere other than their core operations. Looking at the net change in cash and restricted cash for the 9 months ending the 30th of September 2025, it's a negative change of over $1.2 million. This means their cash balance has decreased significantly. Their cash at the end of the period is a mere $135,000. Now let's dig into the notes to the financial statements. These are where the company provides more detail and context. Note 1 tells us E.S.H Acquisition Corp was incorporated as a Delaware corporation in November 2021 with the purpose of merging with one or more businesses. This is typical for a SPAC. They also mentioned their IPO in June 2023 and the funds raised from it, which were largely placed into that trust account we saw earlier. The details about the trust account are important. It holds money from the IPO and is invested in safe short-term government securities or money market funds. The money will only be released for a business combination or if the company cannot complete one and has to liquidate. The company emphasizes that they are trying to avoid being classified as an investment company, which could put restrictions on them. A key point here is the company's ongoing efforts to extend its deadline for finding a business to acquire. They've had to deposit more money into the trust account for these extensions, a common SPAC strategy to buy more time. This also means they are burning through cash and facing increasing pressure to find a deal. The company is also dealing with a new 1% US federal excise tax on stock repurchases, which they note could reduce cash available for their business combination. This tax was triggered by a large redemption of shares back in 2024, and it is showing up as a significant liability, showing that even government regulations can have a real impact on a company's bottom line. This part is super important under going concern consideration. The report explicitly states that the company lacks the financial resources it needs to sustain operations for a reasonable period of time. They state that if they don't complete a business combination by the 16th of December 2025, they will cease operations and liquidate. This raises substantial doubt about their ability to continue as a going concern. In simple terms, the company might not be around in a year if they don't find a business to buy and merge with very soon. Note 2 outlines the accounting policies. This is where the company explains how it records its financial transactions. They use generally accepted accounting principles, or GAAP. For emerging growth companies like this one, they can elect to use newer accounting standards later than other companies, which can make comparisons tricky. They talk about cash and cash equivalents, and in this case they have very little cash and no cash equivalents, meaning no short-term investments that can be easily converted to cash. Their cash balance is quite small, as we saw earlier. This section further explains those redeemable shares. It clarifies that these shares are treated differently in the accounting because the redemption isn't fully in the company's control. The balance for these shares is substantial and it is presented as temporary equity, meaning it is not considered permanent capital. The increase in this amount is a direct result of the company's net losses and the redemptions occurring. Note 3 details the initial public offering, or IPO. It clarifies that the company sold units, each containing a share of common stock and a right. These rights are essentially options to get a fraction of a share of common stock upon a successful business combination. Then we have the private placement, where the company sold warrants to certain parties like its sponsor. These warrants give the holders the right to buy company stock at a set price. Warrants are common in these types of deals and they can impact the future finances of the company. Related party transactions are always interesting to look at. Here we see transactions involving the company's sponsor and its officers and directors. This includes sales of founder shares, conversion of Class B shares to Class A shares, and agreements for administrative and consulting services. These are common in SPACs, but it is important to see how these related parties are involved and compensated because it can influence company decisions. There is a mention of the sponsor converting a large chunk of Class B shares into Class A shares. This is often done to align incentives with public shareholders. This note covers agreements and potential issues. They have registration rights for certain shareholders, meaning those shareholders can demand their shares be registered for sale. There is also mention of an underwriting discount and a marketing agreement with the underwriters that could lead to a substantial fee if a business combination is completed. A big piece of news here is the business combination agreement signed on the 15th 16th of September 2025. This agreement outlines the terms for merging with the original Fit Factory. Limited, this indicates E.S.H Acquisition Corp is actively pursuing a merger so that going concern warning might be mitigated if this deal goes through. The agreement details how shares will be exchanged and how the company will become publicly traded after the merger. This note gives us more breakdown on the different classes of stock. We see preferred stock, authorized but none-issued Class A common stock, and Class B common stock. As noted before, the Class A common stock subject to redemption is a very significant number. This section, MDA, is management's own narrative explaining the financial results. They acknowledge the lack of operating revenues and that their only income comes from trust account interest. They point to increased general and administrative expenses as a key factor in their net loss. They also discuss their liquidity and capital resources, basically confirming they are burning cash and need to complete a business combination quickly. Here they list potential risks, things like economic downturns, inflation, interest rates, and geopolitical instability are all mentioned as factors that could hurt their business and their ability to find a target company. This repeats the going concern warning in more detail. They are using funds outside the trust account for operations and need to complete a business combination by the 16th of December 2025 or face liquidation. This is a critical deadline. They highlight Class A common stock subject to possible redemption as a critical accounting estimate. This is because a large portion of their equity is treated as temporary because of the redemption feature. The value of this redemption is significant and directly impacts their reported equity. This note often contains important updates that happened after the reporting period. Here we see that on the 29th of October 2025, the company received approval to list on the Nasdaq capital market. This is a positive step showing they are still actively trying to meet listing requirements. This is where the company spells out all the things that could go wrong. They reiterate that the completion of their business combination with the original Fit Factory is not guaranteed and depends on shareholder approvals and other conditions. They warn that the announcement and pendency of this business combination can negatively affect their results and that shareholder lawsuits are a possibility. They also touch on international trade policies and tariffs as potential risks that could impact their target business or the combined company. Finally, the exhibits list all the supporting documents. We see the business combination agreement itself and various related agreements like sponsor support agreements and registration rights agreements. These are the legal blueprints for the proposed merger. Now let's talk about what all this means. E.S.H Acquisition Corp is a SPAC that is burning through its cash very quickly. Their general and administrative expenses have skyrocketed in 2025 compared to 2024. This is typical as a SPAC gets closer to its deadline. They often ramp up spending to find and close a deal. The huge negative equity position and the significant amount of stock subject to possible redemption are major red flags. It tells us that a large part of the company's capital is not stable and could be cashed out, creating further pressure on their finances. The good news is they have entered into a business combination agreement with the original Fit Factory Limited. This is a critical step towards avoiding liquidation. However, the success of this merger is far from guaranteed. It still requires shareholder approval and other conditions to be met. The company is also facing a hard deadline in December 2025 to complete this merger or face dissolution. In terms of valuation right now, it is almost impossible to give a traditional valuation because the company doesn't generate operating revenue. Its value is tied to the cash in its trust account versus its liabilities and the potential success of the upcoming merger. A key number to watch will be the amount of redemptions from public shareholders. If the merger gets to a shareholder vote, significant redemptions could jeopardize the deal by reducing the cash available for the combined company. So my take is this company is in a high-stakes situation. They are spending a lot of money to find a partner, and if this merger with the original Fit Factory does not go through successfully, they likely will not survive. The risks are substantial and the clock is ticking. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.